Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. Let's look at the week ahead for the week starting Monday, the 29th of July. It is the busiest week in terms of earnings season, and it's also probably the biggest week for quite a while in terms of the economic calendar. So plenty of volatility for traders to deal with. First and foremost, I wanted to give you an overview of the big ticket items for the week. These are the items that are rated as essentially high risk, high volatility within trading economics. You can see on Tuesday, we have a raft of growth data coming out of the Eurozone that also culminates in the inflation rate coming out of Germany and the JOLTS job openings number out of the US, leading into a week that is going to be dominated by jobs data in the US. In terms of Wednesday, overnight in the morning, we've got the manufacturing PMI. It leads into a Bank of Japan interest rate decision where people think there's a good chance that we could see a rate hike from the BoJ coming at a time where we're seeing big strength in terms of the Japanese yen. So big questions about whether that is going to continue. Will we see them hike interest rates? Will we see them tapering off the asset purchases? Plenty to get through when it comes to that Bank of Japan interest rate decision. Then we're moving to Europe. Once again, we've got inflation coming out of the likes of France, the Eurozone, Italy. And then we've got the Federal Reserve interest rate decision on Wednesday evening. So super busy Wednesday. On to Thursday, we've got the Caixin manufacturing PMI out of China. So continued focus on Chinese manufacturing coming at a time where they've cut 4 interest rates in the region. And then we go into the Bank of England interest rate decision where markets are expecting or thinking we could get a potential interest rate cut. Something I'll go into, but certainly it appears to be a bit of a coin toss here. Then the US ISM manufacturing PMI leading us into Friday's non-farm payrolls and unemployment rate. It's worthwhile noting that I think left off this, they might not have as a high value event, but we've got the ADP payrolls taking place on Wednesday. On Thursday, we should have the unemployment claims. So lots of jobs data, lots of central bank decisions with the likes of the Bank of England and the Bank of Japan and the Federal Reserve and inflation data out of the Eurozone. There's a huge amount to get through. And in actual fact, it was difficult for me to pick 3 topics. Some weeks it's difficult, some weeks it's difficult for other reasons because there's so much going on. This time around, the one area you have to focus on is the US. We've got a huge amount of data over the course of the week. Of course, we've got all that jobs data. So JOLTS job openings on Tuesday, ADP on Wednesday, jobless claims on Thursday, and the jobs report on Friday. And then in the midst of that, we've got that Federal Reserve interest rate decision. Of course, at the moment, we've been seeing this sell-off within the tech sector in particular, seeing weakness in terms of the wider market. People starting to think that maybe the Federal Reserve need to act soon to stop the rout. Well, bear in mind that the Federal Reserve aren't necessarily here to try and save your portfolio. They are here to try and do what's right for the economy. So it's not to say that they will cut interest rates this time around just because of the fact that markets are seeing a period of weakness. And it's, really interesting for this meeting, more so because of the fact that we have got question marks around a September rate cut and question marks around the rest of the year. So currently markets are pricing a 2/3, so over 60% chance that we see 3 rate cuts this year. But that's to start in September. And bear in mind, September onwards, there's only 3 meetings. So it means essentially if we see the Federal Reserve hold off this time around, which is widely expected, the remaining 3 meetings of the year are expected as a base case scenario to all see interest rate cuts from the Federal Reserve. So this meeting essentially is probably more likely a case of Jerome Powell being able to set out his stall, potentially to rein in those expectations. Possibly not. Maybe he's going to talk about his confidence that inflation is moving down to target. Now, I'm recording this late on Thursday, so I haven't actually seen the core PCE inflation figure for June, which is released on Friday, but I have seen the quarterly figure that we saw in terms of the core PCE figure for the second quarter. And That figure came in towards the downside. The weakness of that number gave markets confidence that we were likely to see something akin to that weakness when it comes to Friday's figure. So the Q2 figure came in at 2.9. The expectation was 3.1. So lower than expectations, lower than last time, which was 3.7. And so I would expect or hope that we're going to see some weakness in terms of that June CPI number, core PCE number on Friday. Now, if we do so, then you're looking at weakness in CPI, you're looking at weakness at core PCE, and you're looking at the potential for massive disinflation at the beginning of next year. We've seen a big chunk of inflation at the beginning of this year. So as you go more towards the back end of this year, the Federal Reserve have to work out, okay, I know that inflation is above target, but once we see those big numbers for Q1 stripped out, are we then going to find ourselves back down to like 1% or something like that, right? So if we do see a lowly figure in terms of core PCE, it could give them greater confidence. So really, it's going to be about the tone from the likes of Jerome Powell. Like I've said, we've also got this jobs report coming out. So expectations here of a bit of weakness, sub 200K here, 190K. Unemployment rate expected to remain. Keep an eye out for average hourly earnings. In particular, of course, inflation pressures being highlighted by wage growth, expected to remain at 3.9%. If we see downside move for that, again, it could give us greater confidence that we will see a interest rate cut for September, which markets pretty much think is a given, but also the remainder of the year seeing interest rate cuts each time. So 75 basis points for the rest of the year. This is the trajectory for inflation at the moment, and it highlights why the Federal Reserve are increasingly confident we are moving in this downward trajectory. And so, will that lead us into a position where the Federal Reserve cut 3 times for the rest of this year? Maybe. I mean, look, we were looking not so long ago at a position where it was going to be one rate cut because we saw these big inflation figures at the beginning of the year. There was absolutely no chance we were going to hit target this year, which we probably still won't. But nonetheless, even if that's the case, the idea that we could see really big disinflation at the beginning of next year means that they can move ahead of time. And that's why markets appear to be very confident in a rate cut in September. We can see that pricing here, 85% attributed to a rate cut down to 5 to 525 range. And then you also have an outside chance of 50 basis points worth of downside by that September meeting. Like I said, when we're looking at the back end of the year, you're looking at 3 rate cuts being attributed at, so 57% for 3 rate cuts, and then another 8, essentially 8.8 or 9% attributed to 4 rate cuts this year. So put that all together, and you're looking at roughly sort of 56% chance that we're looking to see 3 rate cuts or more by the end of the year. That should be good for equity markets. So the caveat here, of course, is we've got a huge amount of earnings data coming out. And so where you see earnings data, you see the possibility for significant volatility. And if we see weakness in terms of these big tech names, remember, we've got 4 out of the 5 Mag 7 names reporting. I have provided an earnings preview, so make sure to check that out, covering Microsoft, Apple, and Amazon. So yeah, look, if we get shown the way and it's all about, everyone feels increasingly confident we're going to see 3 rate cuts this year, that could be great. But if it comes at the same time that we see a big turnaround in terms of growth and profitability for these big tech names, it's not really going to count for much, quite frankly. So it's really going to be a case of following both the likes of the indices, the equities market and the earnings alongside this economic data. Now, in terms of the market itself, this is the S&P 500. We can see that things are starting to look up here. We've seen a pullback in towards this descending trend line, and now we're starting to see the bulls coming back into play. It's always difficult to know exactly where the point is where you should buy the dip, but from a long-term perspective, look, the trend is very clearly defined, and you're looking at a market that thus far has been selling off of not too much. I mean, we saw essentially the tech sector being hit hard after Amazon earnings that weren't particularly bad, quite frankly. So we're seeing some upside here. We'd have greater confidence that the selling is done if we see a rise up through your 5585. But certainly with the fact that we're sort of rebounding here from trendline support, I'm just going to adjust it a little bit because so it touches that point here. So as we're rebounding from trendline support, let's hope the worst is over. It's going to come down to earnings as well. But that Federal Reserve interest rate decision, whilst we're unlikely to see a rate cut, could possibly lay the groundwork for those 3 interest rate cuts this year. And hopefully that comes alongside some strong earnings from those big tech names and we can get back on track. But certainly this ascending trend line looks an interesting area to be following for the near term as we try to spot the point for us to buy the dip in a trend that is very much clearly defined as an uptrend, and therefore bullish positions are favored until we see a breakdown through trendline support for the time being. Now, let's look at what's happening in terms of Japan, because this is a really interesting one. We've seen the Japanese yen absolutely soaring of late. And interestingly, at the time that we see equity market weakness, so big tech selling off, the NASDAQ down near enough 4%, the S&P 500 down 2.5%, what happens? The US dollar weakens, and the strengthening currencies are the Swiss franc and the Japanese yen. Now, the Japanese markets are going to be particularly interesting for the week ahead because of the fact that we've got this interest rate decision from the BoJ taking place in the morning on Wednesday. And here we can see markets attributing markets pointing towards an expectation that we keep rates steady at 0.1%. That may or may not be the case. Of course, this doesn't give you any granularity behind that decision, whether it's a close run matter or not. But I can do exactly that with the following chart. So we can see here that the breakdown on whether we're going to see it raised or not actually points towards, on the Icon platform at least, towards an expectation of 67% chance of a rate hike this time around. And beyond that, October being penciled in for another rate hike. So 45% chance up to 0.3, 23% chance that it's up to 0.4. So we're expected to be entering a period of tightening. Of course, we did see that move out of negative territory, but that coming at a time when we're seeing the growing expectations of a number of rate cuts from the Federal Reserve. That really feeds into potential weakness for dollar yen. Certainly, it's been a counter-trend move, but it's something that I have been highlighting for a while now that could come into fruition. And crucially here, what we have seen is a pullback into this key support level that we have here, 151.856 down here, right? So we've tagged it and rebounded somewhat. Will we follow through on that? Here's the daily time frame, big, long, lower shadow at the moment. But we have got a very consistent trend here at the moment. The creation of lower highs is what we're looking for in particular. And that's exactly what we're seeing. So this continued creation of lower highs means that we would need to break the 157.86 to negate this intraday downtrend. Until that happens, the near-term rebound looks like something that could be short-term in nature. And if we do roll over and break through to 151.86, then you're looking at a potential sort of wider period of weakness here for the US dollar against the Japanese yen. It comes off the back of this rally up into sort of trendline resistance. You could say, you know, the bottom end of this pattern points towards us soon enough seeing the bulls back in charge, right? So let's just try and see, oh, wrong type of line there. Let's try and see where we could potentially find some support if this was just going to respect sort of channel support. Let's see. Trying to grab a bunch of these different lows. Something like that. So you could say that we're overextended from that perspective. If I was to grab that down and sort of take that low down there, I'm trying to make it parallel here. So you could say that we're overextended towards a downside from that perspective, but certainly 151.85 is a really key level. If we break below that level, it could point towards a potential exit from this channel. And certainly if we see a hawkish stance from the likes of the BoJ, if we talk about them tapering their bond purchases, these are the kind of things that could strengthen the Japanese yen, coming at a time when people are feeling increasingly confident that we're going to see plenty of easing from the Federal Reserve. So a reversal of a trend that has been very consistent. I don't particularly like to say goodbye to good, consistent trends, but you have to be able to spot the potential turning point. And this is a potential turning point because we're seeing one side moving towards tightening, one side moving towards easing, and that's where we could potentially see that switcheroo. So when we're seeing weakness in terms of dollar yen, no longer is it just a case of saying, oh, it's intervention from the BoJ, because it might actually be the case that people are seeing this as a top for the dollar yen. Let's see how hawkish the BoJ are, and let's see how dovish the FOMC are. And then finally, I wanted to bring up the UK, and we can see here that, you know, we've got a host of bits coming out, but the most important of those is going to be the interest rate decision from the Bank of England on Thursday, expected to drop down 25 basis points to 5%. And that will be a big move. I mean, it essentially kicks off the easing phase. That pivot from the Bank of England firmly sets us on a downward trajectory and essentially means that the job's done. In terms of the pricing, though, it is a coin toss, 50% in either direction. So there's a good chance that we don't actually see it this time around, and instead we see them holding off and cut rates in September, down sort of 71% chance of a rate cut that time around. So there's a lot of indecision for this meeting, but the indecision can breed significant volatility, right? Because it means that essentially if they cut rates, then there's volatility. If they don't cut rates, there's volatility, because it's not necessarily priced heavily in one direction, and then when they do it, it's already baked in. This one isn't baked in either direction. So you're looking at the possibility of significant volatility for the pound. Now, I'm not going to go into massive detail on all these because, of course, I'm covering 3 on this one, but I will be providing different breakdowns in separate videos for some of these major events. So be aware of that. But for this one, giving you a sort of overview and then one key market to watch out for. For this one, I thought an interesting one is sterling against the Swissy. Now, the Swissy is an interesting one because you could be saying that the Swiss, given the fact that they've got such low levels of inflation compared to like the UK, for example, and they've been cutting rates already, and their rates are already so low, you could say, well, we should be looking for particular weakness there. But when you're seeing that pivoting and the SNB pretty much don't have much left to do, and the Bank of England are only just getting started, then you have the possibility of a sort of reversal for that pair. And you can see here this possible big sort of top coming into play here. We have seen support being found at the 76.4. So certainly greater confidence that we've topped out would come with a break below 11219 in particular. But certainly if we do see that interest rate cut from the Bank of England, then maybe we see further downside. And in particular, if we saw weakness in terms of equity markets, then again, people are sort of struggling to try and find those other haven assets aside from the US dollar. And that's why the Swiss franc's been coming into strength of late as well. But certainly we've seen significant downside. Given the fact that this rate decision from the Bank of England is the back end of next week, I think this could be an interesting one. Maybe we sort of consolidate and then set up for the next move. But if we see the Bank of England opt to cut rates this time around, given the fact that markets are pricing in a rough 50% chance of it happening, that could lead to a nice decline here for sterling Swissy. And in particular, if that took us back down towards that 1.1219 level, then we could possibly get into a position where we start to roll over once again. Bear in mind, the last couple of years have seen price largely trading within this sort of area between sort of 1.1 up to 1.16. Well, that's where we've seemingly topped out on a couple of occasions recently, and we're heading lower from that 1.16. So could we be seeing the beginning of another significant sort of period of downside here as we see sterling Swissy moving towards your sort of 1.1 area? Perhaps, but let's see what the Bank of England do. That should give us a good idea on where we go from here for the pound.